1,000 square feet of office space. Capita Green with 700,000 square feet of office space. About 1.2 million square feet of Grade A office space is coming into the markets when the 2 buildings are completed by the end of this year. But beyond that, there won't be any major supply of office space in the downtown core until the end of 2016 or early 2017. The downtown core covers the Central Business District, or CBD, City Hall, Bugas and Marina Centre zones. The limited new supply has some industry observers singing a positive tune on the office sector.
We expect the rents to rise by over 25% over the next 2 years. This will be higher than any other sector within the property space. If you look at the occupancy levels across the island, occupancies have started hitting 91% on average. When occupancies typically cross a 90% threshold, landlord tends to get pricing power. Core CBD, in fact, the occupancy levels are close to 95%. Apart from the supply, you also need to look at the demolitions, taking away almost 2.6 million square feet of supply over the next 2 to 3 years. This is over 2/3 of the upcoming office supply, so it will result into a significant improvement in fundamentals.
The office rental market is strong at the moment. We expect to see 10 or 15% increase in rents this year.
Others are taking a more cautious view. Maybank Kim Eng expects rents to rise by just 3% this year and 5% in 2015. While Daiwa sees CBD prime grade A rents rising 5.4% this year and 6% next year. In the first quarter, data from CBRE showed office rents rose at the fastest pace in over 3 years. Grade A rentals were up 5.1% from the previous quarter to 10.25 Sing dollars per square foot per month, or PSF/PM. Meanwhile, Grade B rentals were up 4.8% to 7.6 Sing dollars PSF/PM. Capita Commercial Trust, or CCT, is positioning itself to ride the market upturn.
For our Grade A buildings, we are undergoing asset enhancement and upgrading our specifications of these buildings, and they have in fact been able to secure better rentals as well as higher occupancies. As a result of that, the vacancy rate in our portfolio is now less than 1%.
With Capita Green poised for completion by end this year, CCT will have 4 Grade A properties within its portfolio. The financial sector is not likely to drive the upswing in office demand this time round. The sector has traditionally taken up 70 to 80% of Grade A space in the CBD.
The banks have been fairly quiet for the last couple of years. We have more recently seen greater interest returning from Asia-Pacific based financial institutions, and I think this could represent a very good, encouraging trend.
Some of the local or regional banks are actually still quite active, but usually it's sort of 1-2 floor deals rather than 100,000 square foot plus deals in the CBD.
But there are a number of sectors that are filling the void left by financial institutions.
The insurance companies are also expanding. We also find energy and commodities sector, as well as the companies that in technology and e-commerce taking up space in the CBD.
Outside the downtown core, there is also a good supply of quality office space. This is in line with Singapore's plans to build regional commercial hubs of activity to bring jobs closer to home. Westgate Tower, with 306,000 square feet of available space, is set to be the tallest office building in Jurong East in the west of Singapore. The Grade A office building will be ready by the end of November.
Westgate is enjoying strong interest for sure. The decentralized office market has in fact had a very decent couple of years of performance, such that at the moment there's only 2.7% vacancy, so very low and tight availability outside of the central business district.
Longer term, in 2016 and early 2017, more office space will sprout up across the downtown core area. Marina One is set to add the biggest supply of prime office space, 1.9 million square feet in total. The project is a joint venture between Malaysia's sovereign wealth fund, Khazanah Nasional, and Singapore's Temasek Holdings. It will comprise residential, office and retail components and is scheduled for completion in 2016 or early 2017. CBIE is optimistic that demand will be strong enough to absorb the bumper supply.
There's just under 2 million square feet per annum average supply over the next 4 years. So that's about 10% less than the 5-year annual supply figures we've seen come online. So in overall terms, the volume is certainly not of concern. There is a high degree of gearing of when the new buildings complete. In 2016, there is about 3.7 million square feet of completion, so quite a high volume. The delivery of that space, however, comes at a time when there has been a relative shortage of space. And Singapore, historically, as it comes into these cycles, will typically demonstrate pent-up demand.
UOB Kay Hian, however, believes rental growth may moderate before picking up again.
2017, there will be some pressure on rents as more office buildings complete. But property office sector runs in cycles. So beyond that, we see good value in the office sector.
The research house remains overweight on the office property sector. It sees more than 50% upside for office property stocks.
First of all, if you look at the basis of the about 50% upside that we have been highlighting, the average spread over the upcycle all the way from 2004 to 2008 was around 2.3%. The current spread is around 3.5%, so that represents almost over 50% upside for the office sector.
CCT and Keppel Land are UOB Kay Hian's top picks.
CCT is our preferred pick because it has the most amount of leases due for renewal over the next 2 years. The prevailing market rents are about 15 to 20% higher than expiring rents, so they will be able to take good advantage of the rental reversions. Besides that, Capita Green acquisition is in the works for the remaining stake. That would again add value to CCT. On Keppel Land, the divestment of Marina Bay Financial Centre Phase 2 will act as a key catalyst. Expect a special dividend of around 11 cents from that.
Maybank Kim Eng is staying neutral on office REITs. It warns that occupancy rate could slide to as low as 88% between 2016 and 2017, as close to 5 million square feet of new office space becomes available. As such, Maybank Kim Eng expects rents to fall 2% in 2016. It has hold calls on CCT and Keppel REIT. Meanwhile, Daiwa has kept its positive rating on office REITs. CCT is upgraded to buy and Keppel REIT to outperform. Daiwa is reiterating its buy call on Suntec REIT.